All right, we are 30 minutes away from the closing bell on Wall Street. As you take a look at where things stand, all three of the major averages now in the red, a huge reversal from what we saw shortly after the open when the Dow was up just over 300 points. Let's talk about it, what we could expect going forward. For that, we have Michael Weisz. He's Yieldstreet founder and president. Michael, it's great to see you. So we initially saw a totally different reaction in the market. The Dow was up over 300 points heading into the close here, now off just over 400. Your big takeaway from the jobs report, the market's reaction, and how this sets us up for next week.
So I think what began as a strong August really ended on a much weaker note. We have the Dow down 4.1%. You have the S&P and the NASDAQ down 4.2 and 4.6. I think what we're seeing is investors are taking more of a risk-off approach. They want less cyclical investments. I think what they're looking for, we continue to see, they want returns. They're going to values. They're going to the value space. They want to see companies that have dividends, and they're looking for less volatility. I think what we're seeing here is energy stocks are really leading the way. What are we up over 40% this year alone, which is far beyond second place, which is utilities at 3.3, 3.4%. And on the other hand, you have tech on the NASDAQ, which we've contracted over 25.5% this year alone. And so you're seeing investors really get more concerned about where the markets might go. They're taking a more conservative approach in the second half of this year. And I think what we're seeing is they're following the Fed's more hawkish response and more concerned about where they're going to be able to generate returns.
So, Michael, as you see investors taking this more defensive play, then what are they rotating out of, and what sort of time horizon are they going to hold that for?
I think that's a great question. Inflation, I believe, plays a big role in that as well, because as you recognize that your purchasing power is lower, you need to make sure that you're investing more frequently to ensure that you're generating a return. What we're seeing is folks move into private markets. JP Morgan just published a recent report that really focused on real estate performance is highest when you have a high and rising inflationary environment, because real assets are typically looking to hold steam with broad price pressure. And so you see rental rates climbing, which we continue to hear in the media as we're in a rental crisis, as we're seeing rental rates increase as net new home sales are declining continuously. And so we're watching people move into private markets, watching real estate be an area of critical focus. What we're also seeing is that folks that have a bit of a longer term time horizon are recognizing that both private equity and venture capital have had significant multiple compression. And so if you're willing to have a little bit of a longer term horizon from your investment perspective, there are some good opportunities to be had where you've seen significant multiple compression, allowing people over a longer period of time to generate a stronger total return and a stronger yield.
Yeah, to your point, the Fed certainly likes what they're seeing in the housing market. How do you think they reacted to today's jobs report? What's the good news if you're the Fed?
I think the good news for the Fed is that the current state of the U.S. jobs is allowing them to continue to take a hawkish response without really tanking the economy that much more significantly. If we start to see jobs fall precipitously, the Fed's approach, at least from the hawkish perspective that they're having, as aggressive as they're having, they're going to have to rethink that twice. At that point, you're going to see inflation continue to pick back up, which I feel like we've started to see subside a little bit. And so I think the good news for the Fed is that their playbook is working to an extent, and the repercussions haven't been severe enough for them to pull back just yet.
Michael, Bank of America was out with a note this morning. 60-40 portfolio falling 4.6% in the month of August, extending the year-to-date loss to just over 19%. When we're looking to protect our portfolios here, obviously that traditional way of investing doesn't seem to be working this year. What's your advice then to investors out there?
We've spoken about this a lot. 60-40 is dead. It's a thing of the past. You got to get away from it. You have to modernize your portfolio. Look at the biggest institutions. Look at endowments. Look at family offices. Where is their money? There's no such thing as 60-40 by smart investors. It's over. You got to have private market exposure. There has to be real estate. There has to be real assets. You need private credit. When you look at where the real value is happening, the private equity industry and the private credit industry have grown tenfold in the last decade and a half. That's where the money is being made. People need to find solutions. And really, that's as you guys know, that's what we do here at Yieldstreet, right? We've been on a mission over the last 7 years to help create better access to private market exposure for that very reason. 60-40 is not going to be what protects your portfolio or helps you get where you want to go.
Michael Weisz just drove the final nail in the 60-40 coffin. Thank you, sir. Enjoy the weekend.
It's over.
It's dead.
Thank you so much. Thanks for having me. Have a wonderful weekend.